Oh, hello everyone. I hope you're all well. I hope you're looking after yourself. You're looking after your family and friends, looking after your animals, looking after everyone in the world and just making this a better place. So I couldn't sleep last night, so I probably had a couple of hours sleep and I'm up working again. I just wide awake for some reason. Maybe I drank too much coffee. But anyway, I thought I'd just look at, as I promised, the correlations in markets. What is the relationship between gold and silver and the equity markets and cryptocurrency markets, particularly when markets are going down? And can we glean anything from correlations in terms of different markets? And can it help us when markets go up or down? So when we talk about correlations, what are we actually talking about? And probably the simplest way to look at correlations is just how do asset prices in terms of the return. It's measured in terms of return on the price, how they move in tandem with each other. If one goes up, does the other one go down? If one goes up, does the other one go up? And generally, what statisticians will look at is how strong that relationship is between, -1 to +1. So essentially, if something's fairly strong, you're going to have it closer to 1 as a positive relationship. If something's negatively strong, like a very strong negative relationship, it's going to be closer to -1, for example. So something statistically strong is going to be over 0.7. Something that's not very strong is going to be, basically 0.005 or 0.1 to 0.3, as you can see by this this chart here. So one thing I want to note is correlation does change, and it changes quite dramatically. People run correlations over a 365-day period, or in the Americans' terminology, 360-day period, or they run them over a 90-day period, or they even run correlations over a 1-day period. So basically, the longer you run the correlation, the less your absolute number is going to be because you're running it over a fair amount of time. If you run it closer, like a 90-day or a 45-day correlation, you're going to find that number is going to be a lot stronger, a lot higher. So to give an example, say I ran, say XRP over a 365-day basis, say to Bitcoin, I might get 0.47 as a positive relationship. But if I ran it over, say, a 90-day, I might get 0.62. And if I ran it over like a 5-year period, I might get less than 0.47, if you know what I'm saying. It's going to be a lot less. So, but what I will say is correlations do change, and they change all the time between asset classes and between cryptocurrencies or stocks within those asset classes. So, for example, stocks can change their relationship with each other, and so can cryptocurrencies. So to sort of get the benefit out of correlation, you need to keep running it and keep an eye on it. And that's probably the best way I can describe it as such. Most people call it the Pearson's correlation coefficient, and really it's just the way two pairs of assets move between each other, whether it's a negative correlation or a positive correlation. And as I said, you can run it for currency pairs, stock pairs, bond pairs, corporate credit pairs, all sorts of things. So it's pretty good. What I'll do is I'll take you through this correlation chart. You can pull these off the internet anywhere, and they're really easy, but I'll just take you through it just in case you're not aware of how to read this. So if you're looking at, say, a 365 days basis, and you're looking at, say, XRP's correlation to Bitcoin, in other words, how does XRP's price move in terms of Bitcoins, you'll see the positive, the correlation is 0.47, which is a positive correlation. So it's basically saying, say for every 100 cents that Bitcoin moved, XRP would move by 0.47. Say if we go to Bitcoin and Ethereum, you'll see it's more of a positive correlation. It's closer to 1, so it's a stronger relationship. So in other words, say Bitcoin moved by 100 points or 100 cents, Ethereum would move by 67 cents of that 100. You see what I mean? So if we went to, say, Bitcoin and Litecoin, again, the relationship's stronger, 0.69, and the same story. If we go to Bitcoin with itself, it's going to be 1, of course, 1 to 1, as you can see. If we went to Bitcoin and say, so we come down here, we look at Bitcoin down here, and we go Litecoin 0.69, basically that's a fairly strong relationship. So 69 cents to 1 Bitcoin as such. If we go down to rep, it's only 48 cents. So Bitcoin's relationship with the equity market is only 0.02, which is not even significant, and you wouldn't even say it's any relationship. It's a slightly positive, but a very, very weak one. To the volatility index on the S&P, the VIX, which is the volatility index for the Standard & Poor's 500, it's a negative relationship, 0.13. So if that volatility index is going up, then Bitcoin will be going down because it's actually a negative relationship. If the volatility index is going down, then Bitcoin will be going up. And the same like with gold. So it's a negative relationship. So in other words, if gold's going up, Bitcoin's going to go down. If gold's going down, Bitcoin's going to go up. Does that make sense? I hope so. And so, you know, just a slight negative relationship as such. So I'll have a look at the next slide here. What have we got here? So I just want to show you, so we've gone through that one there. So as I said before, correlation does change over time, and you'll see it mainly, I mean, you'll look at it and you'll look at it, you could look at it with anything clearly, but you'll actually see it very much with, say, XRP. If we go back to XRP, say in July of this year, you'll see the correlation, the rolling correlation between XRP and Bitcoin was around 0.85, and it was fairly strong. As the time's gone on, and as we've come closer into September, everyone noticed that XRP is rallying more on its own without Bitcoin rallying, or in other words, Bitcoin going up. So that correlation's gone from a very strong 0.85 down to about a 0.5 or a 0.6, 0.55 to a 0.6, as you can see by this blue line. If we look at, say, a Bitcoin Ethereum's over 0.85, about 0.87, and it's still around, looks like it's still 0.77. If you look at a Bitcoin and BCH, you know, you've still got that correlation as being very strong. So in other words, you know, a $1 movement in Bitcoin is going to, you know, if you assume a linear relationship, it's going to be a 0.85 move in Bitcoin Cash, for example. So you're going to get a very, very similar move because they're going to move, you know, there's a strong positive correlation between Bitcoin Cash and Bitcoin. So what you're trying to do in terms of diversified, and how can you use these correlations? So for example, say you're setting up an investment portfolio like I am, and you want to get a diversity of a portfolio, and you don't want all your eggs in one basket. So, you know, you're building a portfolio for the market to rally. In other words, you want a portfolio that's going to get all the gains from a market actually going up. So what you would do is basically find coins that have a very positive relationship to Bitcoin, or coins that you believe are going to outperform, say, Bitcoin, so that you get the benefit of the market actually going up. Or alternatively, you can actually have a hedge portfolio where you're actually buying coins that have a negative or a less positive relationship to Bitcoin, so that if Bitcoin goes down, say a coin like XRP may go down by less than Bitcoin. So in other words, if Bitcoin goes down by $1, assuming this relationship holds, say with BCH, say they've still got a 0.8 positive relationship, Bitcoin goes down by $1, then it assumes with correlation, a linear relationship, that the coin of BCH would go down by 0.8. If you're holding XRP, with the relationship being less than 0.8 or whatever it might be, it might be down to, what is this, about 0.55, then XRP is only going to go down by 0.55 compared to Bitcoin 1, if that makes sense. So that's how you can use these for, you know, for portfolio investing, either from a hedge perspective or a diversified perspective. Also, in markets, a lot of people use correlation to spread trade. In other words, they'll buy or sell assets in the same market. Say you're in the equity market, and you buy, say, a bank, and you spread it against another bank. Say, for example, in this market, NAB and Westpac always used to trade very similar. So you might buy NAB and sell Westpac or vice versa. And the correlations used to be very, very close together. So people will use that also to spread trade markets. So in other words, get into one asset vis-a-vis against the other. So buy and sell one asset against the other. So correlations are good to look at just to see how an asset moves in tandem with another asset, and whether that relationship is changing, so you can basically make money out of it and profit from it, and have your investment portfolio or your trading portfolio in the right position to actually make money from it. So if we so I don't want to bore you too much with these stats. There are a lot of stats here. If we go to, I just want to show you something. If we go to a shorter time frame, and I showed you the 365. So say, for example, we go to, I'll just take it back to the 365. So we go to Bitcoin and 365, and you're looking at XRP, which is 0.47. Keep that in mind for 365. Then we go to a shorter time frame of 90. You'll see the correlation for Bitcoin and XRP is a lot higher at 0.62. Okay, because we're talking about a shorter time frame, and price actions, obviously, closer to home, if you want to call it that. There's a stronger relationship in the price of each against each other, so that relationship's going to be a lot higher. But you'll still see the same sort of relationship. So in other words, Bitcoin has a very strong relationship to, say, privacy coins, and say to Ethereum. And less of a strong relationship, say, to XRP, the S&P, the VIX and gold and that sort of thing. So we go here, Bitcoin against the VIX is negative 1.13. So in other words, if the VIX goes up, Bitcoin goes down, and vice versa. Against gold, it has a very immaterial negative relationship. So in other words, if gold goes up, Bitcoin goes down. But if we go to the 90-day, you'll see that that's a lot higher. So the shorter time frame, you'll see that relationship is negative 0.18. So in other words, if Bitcoin goes down by 1, gold goes up by 0.18, assuming there's a parallel relationship. Okay, so I hope that's clear. It's sort of confusing, but it's not really. So I did some of my own stats, and I came up with pretty similar sorts of stats, but just for a longer time period rather than a year. And basically, I looked at gold data, silver data, and S&P data, the S&P 500, from the 13th of August 2008 to the September 12th, 2018. So it was about 300, database points. We're looking at it effectively 10 years. But keeping in mind, it's only 10 years, and generally when people run correlations, they run them for a lot longer. So we basically had, say for gold, and this is, the average price was that $1,200, for say for silver, $21, say for the S&P 500, $1,700, max on gold, $1,900, silver $49, S&P 2,900, so to speak, minimum 681, 903, 665, just so you get an idea. Maximum return 903.12, 411. So the average returns across there, and basically the price there. So, if you look at these, that gold's, around its average, silver is, under its average for pricing, and in the S&P is over its average. So basically my figures came up with a negative relationship between gold and the S&P, the equity market, and a negative relationship between silver and the equity market, and it's very immaterial, that relationship. So you wouldn't even bother with it because it's so small, and this is over a 10-year period. If we look at basically Bitcoin to the S&P, and this is very consistent with the data that I showed you previous. If we look at Bitcoin to the S&P, there was a very slightly positive relationship, and a very slightly positive relationship to the S&P and XRP. So Bitcoin was 0.02 and XRP was 0.07. But in other words, it's not statistically significant. It has to be over 0.5 to be statistically significant. And it was basically very, very minimum. So it does say a slight positive, but it's not, again, you can't really do anything with that because it is so low. And, we just looked, then I looked at the returns, obviously Bitcoin and the S&P and that sort of thing. So Bitcoin, over that 10-year period, the average price was 1,700 odd. Maximum price was about over 20,000, minimum was 4.2, maximum return 36%, average return about 0.1, and the price when we ran this was 6,203. XRP was, the average was 0.2155, total highest price was 386, minimum was 0.225, maximum return 9%, average return 0.019, and price at the time I ran this was 26 cents. So, so basically what it's showing is a slight positive relationship, but we can't really do anything with that data because it's not significant enough or material enough. So what have we got from this data really? All we can conclude is correlations constantly change between assets, and they obviously change over time, but they obviously change over a designated time frame. So whether it be a 365-day, a 45-day, or a 90-day period, that sort of thing, correlations change. The shorter the time frame, the stronger the relationship. With correlation, it assumes that there is a linear relationship, and it may not be a linear relationship, a straight line this way or a straight line this way, positive or negative. In markets, particularly in fixed interest markets, you have concave relationships, you have convex relationships. In other words, interest rate yield curves are not straight up like this or straight down like this. They can be up and down in all different places, right? So they can be certainly different shapes. So what do we come up with just overall then, just looking at the 365-day correlation? We basically found, and people realize this, that XRP now is less dependent on BTX. So in other words, if Bitcoin goes up or down, XRP is not being so influenced by Bitcoin's price. And that's very obvious in the last couple of days of price behavior of XRP. Don't forget, I ran this on the 12th of September, but even then, excuse me, I found that price correlation was changing. So what we found is over 12 months, XRP used to have a 0.85 correlation to Bitcoin. Now that's down to about 0.47, almost half. So in other words, what Bitcoin does, XRP only does half of it now, not nearly 1-for-1, and that's quite significant. Okay, there's been a significant change in the correlation relationship between Bitcoin and XRP. What else we found is XRP and Bitcoin have immaterial or not statistically significant positive relationships with the equity market of 0.02 and 0.07. So in other words, if the equity market goes down, these two may go down, but very, very slightly small. Now, I will qualify this because we don't have a lot of information in terms of cryptocurrency. We only have about 10 years of information, with Bitcoin particularly, and with Ripple XRP, I think is about 2015 or 14. So we don't have enough data really to make a conclusive assumption. But either way, 0.02 or 0.07 is very, very minimal, and it's not statistically significant. And, and all I can say is, there could be a slight positive relationship because of cash flow, liquidity. When we get equity markets going down in a big way, we see that the reliance, people need cash, and they need cash fast. So they pull cash out of other markets. And that's probably why you do see other markets going down, because people are liquidating their cash positions to basically pay up on their margins in the equity market. And that would make sense to me. So it doesn't surprise me it's slightly positive, but it only slightly positive from a cash position, having to get money out of other markets to prop up your equity position, so to speak. We also found from the stats that XRP and Bitcoin just have a very immaterial or non-significant relationship to gold. XRP had a very small positive, and BTC had a very small negative. Also found that Bitcoin had a very strong relationship with privacy coins, Litecoin and Ethereum. And, up until the 12th of September, those relationships were around correlated about 0.7 to 0.75. But notwithstanding, we have seen Ethereum underperform the market last month in August, and that relationship did change quite a bit. And as I said, correlation does change. We also found that XRP tends to have a strong relation with ETC for some reason, and Stellar. We'd expect it of Stellar because, Stellar does have a couple of qualities which are similar to Ripple, but not all, very minute. But ETC was a bit of a surprise to me. And we also found that to hedge your portfolio, a coin called NXT has less of a positive relationship to Bitcoin and XRP than any other coin. We also found that cryptocurrencies generally have a weak negative relationship to the VIX, which is the volatility index for the S&P, for the equity market. So if volatility is going up in the equity market, it means you're going to get a sell-off very soon. You'll find that the crypto market will slightly come down because it's a negative relationship. So volatility will go up and the crypto market will come down. It's not significant. It's around 0.13, but it is slightly there. With gold and silver, we did find that there's a slight negative relationship, but not significant. So the surprises for me, I have to say, and I ran my own data, were for Bitcoin futures and Bitcoin. And don't forget the futures market only operated since October of last year. So maybe it was because the database was a very small database and I didn't have enough data. But I found like a negative relationship of 0.1295, which, I thought it might have been stronger than that. But I didn't also expect it to be negative. I actually I thought it'd be more positive than negative. So that surprised me. Unless they're selling futures and then buying the physical, or buying the physical and selling the futures, because it's an inverse relationship. So what I'm going to do is I'm going to wait until I've got more data and run that again, and just do some more research on that, because I found that was a bit of a surprise that I wasn't expecting. And also I did think that the equity market would be more of a stronger positive on the main for cryptocurrencies, but it wasn't. It was quite small. And also I wasn't expecting the negative relationship with the VIX to the crypto markets. And also there was a small positive to Treasury. So overall, some of the results did surprise me a bit. Anyway, I hope this helps, guys, just for education only. I'm not a financial advisor. It's just, something, food for thought, basically, to teach you how to look at other stuff as well. You can pull all this off the internet. I've got some resources there. Anyway, please be kind to yourself. Please be kind to your family and your friends. Be kind to your animals, your putty cats, your beautiful dogs. And please be kind to strangers and just make this place a better place and a better world. And I've got the disclaimer, this is just education only. Thanks, guys. I hope you're all well. Bye for now.